So good afternoon, everyone. Welcome. We're going to be discussing Big Lots today. This is Taylor Ricketts, and I'm just going to kind of jump right into it. Big Lots is in a fairly challenged situation. We'll talk through a lot of that later in the presentation regarding balance sheet and cash flow, but a lot of it, frankly, just stems from negative comparable store sales. They just reported their 9th quarter in a row of negative comps. And, we're not talking about -1%, -2% comps. The second quarter was down 14.6%. And the very little silver lining is that it was improved from -18.2% in the first quarter. Really challenged situation. As we kind of look forward to the rest of the year, they're still predicting at least 2 more quarters of negative comps. Comps down low teens in the third quarter, comps down high single digits in the fourth quarter. So, what's going on there? There's a lot of things. There's some macro headwinds where Big Lots kind of primary lower income consumers being just strapped for cash. Inflation has very much so hurt this consumer. They pull back on discretionary goods, which is what a lot of Big Lots sells. But also, Big Lots had this one-time incredibly disruptive hits their business. Their furniture manufacturer, United Furniture, just went belly up last year, and Big Lots has had at least 2 quarters, if not 3 quarters now, of negative performance where they just could not procure the goods to put it into the store to sell. We'll get to this. Management does believe that they're kind of beyond that situation now. They think third quarter, fourth quarter, that's why you're seeing this uptrend, that furniture will kind of come back, but that definitely impacted the business. So you kind of look at this by category, it's a lot more of the same. You have basically everything kind of trended up in the second quarter, but it's also still very negative. Furniture was challenged from that supplier issue, and furniture is its largest category, was 25% in this year. It was close to 30% last year. It's also one of its highest margin good lines. So, when furniture has been doing well, it hits the P&L that much harder. Additionally, seasonal business, they do a lot of outdoor furniture in the summertime, a decent amount in the wintertime as well. Well, there was a atypically cool start to the summer that hurt the seasonal business. And then, oh yeah, by the way, that lower income demographic was not really too keen to buy high ticket items this summer. So that seasonal business took a major hit. The non-discretionary parts of their business did relatively well. Consumables were down only 8%, food down 5% this most recent quarter. But still, those are negative comps despite inflation, which we're not seeing in a lot of their peers like the Walmarts of the world, where you're seeing consumables doing pretty well. So I guess basically it's a challenge situation overall. I will say I think there's some things going kind of in the right direction here. Big Lots, somewhat recognizing its challenges, hired a new chief merchant and new chief marketing officers in the third quarter last year. Their goal here is to just become they're trying to reinvent themselves as a low price leader, to own closeouts, novelty, treasure hunts. To that end, they've made bargains and treasures 66% of the store's assortment versus 40% historically, to kind of just, again, be that value provider and create this treasure hunt aspect, similar to some other competitors that have been doing much better. So, without saying, when comps are deteriorating that quickly, margins are not going to kind of go up. But the gross margin situation is yet to bottom. We've seen year-over-year erosion for at least 2 years now. Major hits from markdowns as well as they try to move this inventory, the stale inventory sitting on the shelf. However, that said, I think at least what management's saying is they think the third quarter gross margin will improve year-over-year for the first time in 3 years, and it'll grow as well in the fourth quarter. Part of that is because the furniture business, which has been suffering so much, will actually start coming back in the third quarter. They've also taken several major steps to cut some cost out of the business. They've announced $100 million of structural SG&A savings, really all this year, at least on a run rate perspective. So some of that will hit next year, but that's from staffing changes where they've reduced the staffing in the store. They've realigned a lot of their headquarters functions. They've also closed 4 distribution centers of their e-commerce network to kind of help just take out some costs from the system. And then lastly, they also announced more recently this Project Springboard, which is an additional $200 million of bottom line opportunities. Yeah, I don't want to go into too much of this one. This is what they had Alvarez and Marsal in. It was a financial advisory firm to help them identify some cost savings. There was everything from e-commerce to sourcing, everything you can imagine. I personally think just outside looking in, $200 million is a very bold prediction. For a company that only does $5 billion in sales, that's roughly 4% of sales. That's a huge commitment for SG&A savings for any kind of company. But despite kind of what's maybe to come, ultimately EBITDA through the last year is still deeply in the negative. $77 million negative EBITDA in the first quarter, $72 million negative in the second quarter. And, the third quarter is going to be there as well. Fourth quarter should have some improvement because generally, like most seasonal businesses, their fourth quarter, they do generally make money. But, it's a very challenged situation from just margins and EBITDA perspective. And with negative EBITDA, what we've seen is just a ton of cash burn. Free cash flow is negative $300 million last year, negative $180 million year to date. A lot of that's from the negative EBITDA, but also from working capital challenges as well as interest expense, which has risen with higher interest rates. And then, share repurchases haven't helped either. Go back just a few years, and over the last couple of years, they spent $650 million buying shares. Oh, they probably like to have that cash now, or at least buy the shares at the price now. There have been no repurchases year to date, and there's still a bunch out there, but I think management has wisened up and is not really planning on any repurchases in the near future. But I think again this is a bit of a mixed story because though very challenged year to date, very challenged the last couple of years, the second quarter did see some sequential improvements to operating cash flow. Operating cash flow is actually positive in the second quarter as working capital improvements offset the EBITDA burn. Also, when I look at the balance sheet now, some primary metrics are back in place. Inventory, less than $1 billion. That's in line with historical norms for this time of year. Accounts payable at $339 million. That's back to kind of a seasonal number for them that is not out of line. So, it looks like they're fully caught up on payables. Looks like they're fully caught up on, or at least have a pretty tight inventory number where, that was a bloated thing in the last 2 years. So, how's this impact the balance sheet? And this is kind of, I think, where the scare happened earlier this year. So traditionally, Big Lots has maintained very minimal debt. The company ended fiscal 21 with no debt. It was a kind of crazy situation, consider that from where they are today. And even with the cash burn, debt only increased to less than $500 million as of the second quarter, about $450 million net of cash on the balance sheet. That isn't a significant number when you consider that just 2 years ago, EBITDA, Big Lots generated $423 million of EBITDA, more roughly levered only one time, more than that even the year before at $558 million. But obviously that's not where they are today. And more importantly, the cash burn stressed liquidity. Big Lots, the only debt on the balance sheet is the revolver, and that's also their source of liquidity. And that really liquidity took a hit this year, down to $258 million in the second quarter. Pretty scary, especially going into the back half of the year and kind of needing to make a lot of purchases for the back half of the year, the holiday season. That said, management did a fantastic job of closing this sale-leaseback transaction. This was announced earlier this year, so to sell their Apple Valley distribution center and virtually all of the remaining owned stores. They still own an HQ. They still own a couple more stores. Two of them they're trying to sell that they think get for another $9 million. But they generated proceeds of $294 million in the third quarter. That's this current quarter, received after quarter close. $193 million of that was to be used to pay down the revolver, so to boost cash balances. And again, they think they also have another $9 million coming at some point in the future from those two other stores. So kind of what does this mean? What's this kind of looking at from a cash perspective, balance sheet, liquidity, all that kind of stuff? Well, the short of it is the sale leaseback, which just closed, did solve their immediate need for liquidity. based on the proceeds as well as management's guidance, I put together a little chart or table up on the right of where I think kind of cash is going to go the rest of the year. And the short of it is that in the third quarter, despite negative EBITDA, despite negative hits from working capital, they'll be cash flow positive because of the proceeds. And then we get to the fourth quarter where they actually make a little money on EBITDA. They should have a little bit of favorability on working capital because things sell through. They should be strongly cash flow positive. And they'll end the year with roughly $250 million of debt and an adequate liquidity of nearly $450 million. Now this is optimistic. This is based on management's guidance. But I think regardless, this case is through January of next year. This is a fairly safe runway for Big Lots for at least the next 2 quarters, if not 3 or 4, based on those sale leaseback proceeds. That said, the longer term, it really just hinges on the operations. No company can survive with negative double-digit comps over and over again, and margins just continue getting pressured. We do think furniture should improve as we move past these supply chain issues related to the kind of going back out of business of United Furniture. Management said that as well. The company should also benefit from Bed Bath & Beyond closing. 60% of stores are within a 10-mile overlap of Bed Bath & Beyond. So, that kind of bears to reason that there should be some pickup there. And to that effect, Big Lots has recently opened up and piloting this new store called Big Lots Home to kind of more cater to the home goods sector. I think the jury's still out on that one. It's a brand new format for them. However, I wouldn't get too excited here. The consumers still are under pressure. The restart of student loans won't help. This is a challenged consumer, and Big Lots kind of still needs to prove that it can kind of come back to the company it was, where it was generating strong EBITDA in prior years. But ultimately, what it kind of comes down to the next 6 months, next year, I think Big Lots is fairly safe. I think this is a conversation we could easily be having this time next year regarding their next holiday season, because they just haven't improved the business enough to kind of show us that they're going to be around for a while. So I'm going to pause there and open up to questions. Please enter some if you can. There's a question comes through about how much of their business is related to pet. It is not a big number. It's about 12% of their consumables business, which is only kind of a mid double-digit number right there as well. So probably 3% of their business or so is pet at most. We do have Big Lots rated as an E1. It's been a kind of quick trajectory downwards for them, coming out of a situation where they had no debt on the balance sheet. Basically went from having fantastic operations, no debt on the balance sheet, to fairly levered and not a lot of liquidity. It quickly deteriorated to E1. A question came through about share repurchases in the past. Well, I'm sure hindsight's 2020 there. They were making very significant money in the 2020, 2021 time period when people were remodeling their homes. There was a lot of home purchases, a lot of furniture being sold in the stores. They made a ton of money, and kind of the whole sector did. So, to some degree, they had no debt on the balance sheet. Why not repurchase shares is I think the approach they took. And then the situation just drastically changed in 22 and 23, where consumers' interest rates shot up, less homes sold. They stopped kind of buying furniture for these new homes they weren't buying, et cetera. And now it's, again, hindsight's 2020. Actually, I have a few questions coming through, so let me try to catch up on these. Any other unencumbered assets? They do own their headquarters. So when Big Lots announced the sale leaseback transaction, it was going to be for the headquarters, the distribution center, the stores that sold these other 2 stores, and that number was around $370 million. They generated $294. They've got another 9 coming in for these stores. I think that kind of, you plug and chug there, that the headquarter could be worth somewhere around $60 million. But but that might be optimistic, and there could be a very good reason why the headquarters building did not sell. That would be the only other unencumbered property. Store openings, store closures. Yeah, so they've opened 4 stores to date. They're to open basically another 15 this year. They've closed 7 stores this year to date, and they plan to close another 50, really all in the back half, all in the fourth quarter. 50 is a fairly sizable number, but they're in retail at 1,400 stores. That's 3% of the base. Their store model is, and what they've said is they're going to try to get more into the rural environments. So I would imagine these 50 stores just do not fit that model. Similar question came through on, after the sale leaseback, it seems survival depends on operating results. Fully agree. They may have 1 or 2 more assets, that headquarters I mentioned, as well as a store or 2, but they've got to get the operations right. Things are trending the right direction, but they're all still deeply negative. They're not generating EBITDA yet. They'll be negative roughly $120 million EBITDA this year, even with management's kind of optimistic, or at least my estimates of their optimistic fourth quarter, but they're still deeply negative. So they've got to get that right. A question came through that if there's a slice of the consumers that might shop Big Lots as they might trade down because of inflationary pressures. Absolutely. I think Big Lots tries to position themselves for that. If nothing else, they should get the Bed Bath & Beyond traffic Tuesday morning as well. Like there's fewer home goods stores today than there were a year ago. But at the same time, I think the analogy, the rising tide lifts all boats. Right now, the lowering tide of a demand for home goods is just hitting Big Lots as well. Debt covenants with the revolver that could impact liquidity. I don't think so. I've looked at this as well. It is pretty much so just based on inventory, which they have fairly strong inventory. It's a borrowing-based calculation. I don't think there's any covenants to be aware of for the revolver. Let's see. Somebody asked me a question, how realistic is their forecast? It requires them, their forecast for just the next 2 quarters requires them to do better than they were doing prior year, which they clearly did not in the second quarter. But the biggest thing that I think that gives me a bit of confidence is management's saying that the furniture hiccup that they've had is over. That the third quarter and the fourth quarter, they're now back online with their new furniture distributor, and they're going to have new assortments in the stores, et cetera. And that's a big chunk of their business that really took a hit these last 2 quarters. So I think that's, your question is how realistic is their forecast? I think it's realistic enough if what management's saying there is true. Somebody asked about Alex Partners in there. I thought it was Alvarez Marcel. So there definitely is a financial advisory firm in Big Lots. Big Lots has made that very clear. That is, they gave Big Lots Project Springboard. I have not heard anything about a financial advisory or legal advisory firm being in there for any type of restructuring activities. And I wouldn't think that's the case. They did this sale leaseback. They've got liquidity, they have time. And, they did get Project Springboard off the ground, which is $200 million of cost savings from one of these advisory firms. A question came through about would Big Lots be best served by trying to restructure under Chapter 11 to get out of some of their legacy urban lease obligations and to right size. Maybe that, but I will say these leases, executory contracts and leases, are really the only unsecured debt on the balance sheet or obligation they could restructure on the balance sheet. And I don't know how big of a number that is. I said they're going to close 50 later this year. That's what management's saying. It's maybe is the best answer there. Oh, and it is Alex Partners. Sorry, it's not Alvarez and Marcel. It is Alex Partners. But Big Lots right now does not need to restructure. Big Lots needs to work on its operations to improve its operations so it can make money again and, kind of have a good path forward. Somebody asked the question of what are the prospects of taking on additional debt? And yeah, I think so. So I think one of the things management's probably shaking its head at is why did they not have more debt on the balance sheet? They could have added a term loan when they were doing very well. That term loan would, assuming they retained the cash, that term loan would have provided them adequate liquidity right now, so they wouldn't have to worry about any type of liquidity crunch. So I think, if Big Lots can, to some degree, turn the corner operationally so it generates some cash again, they could easily go to the banks and try to put some debt back on the balance sheet. What other levers they have? I hesitate to say because I've been just blown away with some of these like share agreements where Bed Bath & Beyond was issuing shares with like a week until its bankruptcy. There are probably some other levers Big Lots can pull besides simply selling its assets, but it's unclear how effective those will really be. Somebody asked the question, when does the revolver mature? The maturity is September of 2027. So we've got some time. So somebody asked also, what's the interest rate on the revolver? The revolver has a floating rate, basically the overnight rate plus 2.5%. So I think that's somewhere around 7.5%, 8% right now. But it, obviously, as interest rates have increased this year, that's gone up. There are a decent amount of questions still coming in. Are labor cost challenges still a notable impediment to improving profitability? Yeah, I mean, I think in retail in general, labor costs and the rising labor costs have been a challenge. But Big Lots was making strong profits just 2 years ago. I wouldn't say labor costs alone are not Big Lots' challenge. Big Lots' challenge is that its business, its top line has deteriorated so significantly and its margins have deteriorated so significantly because it's been forced to pursue markdowns to move stale inventory. I think going forward, management's going to be very focused on kind of right sizing its ordering, maybe even missing some sales so it doesn't over order after just 2 years in a row of incredible markdowns. Oh, here's one. Sorry. Do I think bankruptcy is a concern in the near future or in the 2 to 4 year window? So I think 2 to 4 years is very difficult. Big Lots is a quarter to quarter company right now, simply because of where they are in the balance sheet and what they're still burning operationally. 2 to 4 years is very tough. I think Big Lots has every tool at its disposal to right its ship and kind of be fine in 4 years. But at the same time, Big Lots could not make it 2 years if it does not operationally improve. Big Lots, but I clearly think that Big Lots will be around for another 6 months. And then again, if they report 2 more quarters and they aren't improving, I think that's when the real conversations start happening, because at that point, liquidity will be sinking. And, I mentioned before, they still have $400 million payables out there. So liquidity would take a hit pretty quickly from that. But I don't think that's the case in the next 6 months. Somebody asked the question, interest coverage tracking. Yeah, so EBITDA right now is negative. EBITDA is negative $77 million the first quarter, negative $72 million this quarter. EBITDA, I suspect EBITDA will be negative next quarter as well. So interest coverage itself is negative because they just aren't covering it. For the fourth quarter, assuming they pay down the debt, interest coverage for the fourth quarter would be strong. But that's 1 quarter of the business. That's 1 quarter of the year of their business. For the full year, they'll still be negative EBITDA, even in this somewhat optimistic, or at least management guidance scenario. So, everyone, thank you so much. I really appreciated speaking to you. I enjoyed all the questions that came through. If there's any questions I didn't answer or anything kind of further questions or thoughts, please send me an email. Look forward to hearing from you. So again, thank you so much and have a great day.